Hello friends. Last week in my video, I updated you with what's happening in the market, saying that pro-cyclicality, of course, is on the cards, but what we are going through currently is known as the phalanx formation. I even gave you a very brief description that there would be intermittent rallies, very strong upthrusts, which would basically also mislead you into thinking that a bull market has started. And look what happened on Friday. Now, this video is all about whether what happened on Friday is a precursor, a beginning of a larger up move, or is this up move going to run into resistance? I'll discuss all this in the process of this video itself. So stick with me right till the end. For now, let's start with the usual format of the video, and on your screen right now is the weekly market roundup, and that tells you that it was the Bank Nifty that led the rally from the front with the Nifty 50 following suit. The US dollar index continued to rally, and it is now at almost 107.50, almost there. Now, in spite of the dollar index rising, and the dollar is the invoicing currency in the international commodity markets, commodity prices still went up. So gold, silver, crude oil, natural gas all escalated, primarily due to also concerns about escalation in the hostilities between Russia and Ukraine. Indian 10-year benchmark bond yields rose 2 basis points. Not a very great sign, as I told you in my previous videos. The USD INR fell marginally, which tells you that the rupee gained versus the dollar, even as the dollar was stronger against the global basket of currencies. NSE gained a little under 0.5% in market capitalization. This is all due to Friday's upthrust. The US indices went up, and that provided tailwinds to our markets. Friends, I now come to the ratio chart, which is the Bank Nifty divided by the Nifty 50. And as you can see, this was the third week in a row when the ratio has tried to basically improve on its prior weeks, but has run into resistance at higher levels. I continue to remain of the opinion that 2.30 to 2.45 is where resistance area lies. It is only after the Bank Nifty versus the Nifty ratio chart exceeds 2.3, 2.4 that I think a semblance of bullishness will come in the markets. Now, you would want to ask me, Vijay, why is that so? The answer lies here in this table. You see, nothing happens in financial markets without a reason, and the reason is also invariably financial. With a huge weightage of 34.25% in the Nifty 50, banking and financial sector stocks are the swing sector. If you don't have a rally in these counters, forget about a broad-based rally at all. Which is why you must watch the Bank Nifty even if you are a Nifty trader. These are joined at the hip. Friends, the ratio chart done. I now start with my in-house indicators, starting with the MWPL, which according to me is one of the most important critical indicators that you can watch out here. The reason why is in this dedicated MWPL video, wherein I've also explained to you the ticket size per trade and the churn ratios and how to arrive at them. So the MWPL, my friends, after making a lower low after the October expiry at 28.04, is now showing signs of peaking out in a lower high. At 38.69 last week, I feel it is already maxed out. The reason, the coming week is an expiry week. I don't expect MWPL to rise significantly from here. So you can see after having hit 45%, it's peaking out at less than 40%. Very clearly, the check writers, the guys who really move the needles and readings in the markets, are actually not writing big enough checks. Can that change? Yes, if the MWPL starts going up suddenly, that can change. And the details I update to you every day after the trading session is over. Sometimes, of course, early next morning. and these metrics are all available on my social media accounts. My contact coordinates come at the fag end of this video, in the description below and in the pinned comment below. Do connect with me there, please. Friends, I now come to the indices and stock futures turnover. These are three concurrent series, and the turnover went up last week. It's a fairly linear comparison, and the turnover seems to have gone up. This is all thanks to Friday. Friday was an outlier in more ways than one, as our charts will tell us as we progress into this video. Friends, I now come to the advanced decline ratio, which after the price itself is the most leading indicator. And not only has the Nifty risen by 1.59%, but the advanced decline ratio, the average of the week, this is an average of all 4 trading sessions of the week, has gone to 1.20, which means for every 100 falling stocks, there were 120 gaining stocks. As long as this ratio remains above 1, bulls are still in the driver's seat. Friends, I now come to the basis. The basis is nothing but the premium or discount prevalent in the futures vis-a-vis spot. Exactly like options premium, basis also shrinks as expiry comes closer. Higher the basis, all other factors remaining constant. Higher the basis, higher the risk appetite. Lower the basis, lower the risk appetite. But in this case, basis is inverted, which means futures are now trading at a discount to spot, with the Bank Nifty at 53 points minus and the Nifty 50 almost 21 points minus. That tells me on Friday there was a whole amount of concerted short selling. Now, as long as the basis is inverted, you should remain cautious and trade on very small exposure. Friends, I now come to our in-house indicator, the impetus. You've trusted it for 4 years and it stood the test of time. What you have seen is, last week I warned you that both the indices having fallen with very high impetus readings, markets are jittery, and sure enough, they remained so except for Friday. Now, the Nifty impetus has risen very marginally, and last week the Nifty rose. On the other hand, the Bank Nifty rose also, but the impetus reading has fallen, which tells me that the rally was A, on very poor momentum and buying force, and B, in the case of Bank Nifty, it was probably more due to short covering than fresh buying. Ideally speaking, the impetus and the price of the indices should go up together. Where do you get this data? Hey, I update this at the end of the day every day, so please connect with me on my social media accounts. Friends, I now come to the lift, weight, thrust, drag indicator. The tutorial of this indicator is in the pinned comment and description below this video. Now, after having jumped last week to 0.40, it's plumbed low to minus 0.70 this week. What it tells me is that at higher levels, markets are unlikely to see a huge amount of fresh buying. Not very surprising after all, because A, it's the expiry week, and B, the other ancillary evidence that I'm going to share with you towards the fag end of this video tells me that it was more of short covering than fresh buying. But follow-up buying, if it emerges in the week ahead, can always change things around. I would rather wait for the bridge before attempting to cross it. Now, friends, our in-house indicators done. I now come to the bond market, which is very close to my heart, because this market funds the price discovery mechanism of all the other asset classes. Now, as you can see, this is the second consecutive week that the bond yields have attempted to go up. And as a matter of fact, last week, bond yields have gone up almost 3 basis points, or 2 basis points, I beg your pardon, which means that bond prices are lower. What does it tell you? It tells you that bond markets are indicating that the possibility of a rate cut may not be too imminent right now, and even if the rates are cut, they may not be very, very aggressive. This is exactly in line with what I've been telling you. As a check writer myself, I understand that cost of funds need to go up if at all coupon rates are likely to get realistic. I'm thinking of making a fresh video on cost of funds concept. I've already shared the hyperlink to Dick Stoken's books, which you can read for free on a legitimate website. I've shared it on my WhatsApp channel, my Telegram channel. Please make it a point to check these books out. if you do not understand the cost of funds, I'm very sorry to say this, but you're going to trade with a substantial disadvantage. And hey, when you're getting these books free, you better grab it. So now that the bond yields are basically telling me that interest rates aren't going to go down in a hurry, it's all the more imminent that we keep the powder dry. Let's not hurry into gilt funds, and let's also wait for higher levels to get into the Indian 10-year sovereign yields. The reason being that we've already laddered since end of 2021 all the way up to 7.5%. So 6.8% really shouldn't really be too much of an eye candy for you and me. Friends, the bond market's done. I now come to the bank Nifty. And as you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions. It gained 1.90%. Friday, of course, being the outlier. But the price still remains below its month-long moving average, which itself is pointing lower. So the short-term outlook is nervous as of now. Secondly, I had indicated last week that head and shoulder neckline was indicated and shared with you. The price has basically gone above the head and shoulder neckline, which is not really very uncommon. What we need to see is whether the price stays above or below it. If it is staying above, bulls are probably absorbing overhead supply. But like I said, many a times the price violates the neckline, goes down and jumps up again before falling all over again. Does it fall next time around? We need to watch that. Now, only a sustained trade above 52,500 will confirm that all overhead supply has been absorbed and a rally can begin all over again. Friends, I now invite you to check out the weekly chart on your screen, and what it shows you is that the price has taken support at the lower trend line of a bullish wedge. The candle that is formed last week is an inside candle, which means the body of that candle is contained within the prior week's candle. The price has also closed marginally above its 25-week exponential moving average, which happens to be a proxy for 6-month-long holding on cost of an average bull. So markets are attempting to find support as of now. Follow-up buying is extremely critical. Let's not forget the Nifty has 34.25% weightage of banking and financial sector stocks within itself. So the weightage makes it a supercritical swing sector here. Friends, in the week before last, this index was number 4 on our most volatile counters list based on statistical beta rankings that I maintain in-house. It jumped 1 notch to number 3. That tells me challenge level just went up for the retail guy. Last week, I advocated an estimated range between 51,775 on the upside and 48,575 on the downside, which held perfectly well. In the coming week, I estimate a range between 52,725 on the upside and 49,525 on the downside. In addition to the range specified, please also check our daily, weekly, and monthly pivot levels that I share on our free Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.59% last week and rose on 2 out of 4 trading sessions. Now it has almost completed the head and shoulder target that I shared with you in the prior weeks. Although the target was at 23,225, the low the Nifty made was at 23,359. Although that target was missed by over 125 points, but we did manage to catch more than 500 points on the downside. So that basically paid off very well. Now the price is attempting to kiss and maybe even surpass the neckline, but it remains below its month-long moving average, which itself is sloping downwards. So the short-term outlook is tentative or maybe even marginally nervous as of now. With the recent announcement of the election results of Maharashtra and other states, the political trigger of the NDA victory may see an initial bullishness in the week ahead, but follow-up buying is what I would look out for. Now, let's take a look at the weekly chart, which shows an inside candle formation, just like the Bank Nifty's weekly chart also. And the price still remains way below the 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average investor. Now, do remember the key to the Nifty 50 is also with the Bank Nifty due to the weightage factor also. The lot size of indices is going to go up because of SEBI's new regulations kicking in, and therefore your capital requirement both for span margin as well as mark-to-market margin requirements is likely to go up. The 25,200 level must be overcome if we need to be conclusively receiving the weight of evidence that all overhead supply has been absorbed. For the week, however, we need to watch whether 24,350 level is overcome or not. On the flip side, if the Nifty was to stay below the 23,600 levels, it could trigger further weakness in the absolute near term. Friends, in the week before last, this index was at number 11. It rose 3 notches to jump to number 8. Challenge levels just went up for an average retail guy. This is not likely to be very good. Now, last week I advocated a range between 24,175 on the upside and 22,900 on the downside, which held perfectly well. In the coming week, I estimate a range between 24,550 on the upside and 23,275 on the downside. In addition to these pivots, please also take a look at our daily, weekly, monthly pivots, which will help you laser precise your entries and exits. Friends, I now come to the last bit of statistical analysis, wherein I take a look at the retail risk appetite as indicated by their turnover footprint in the 4 derivative segments in the market. The weekly chart on your screen tells you that the index futures contributed 5 basis points more compared to last week. Stock futures segment contributed 9 basis points more last week. So that tells you that risk appetite is higher, although part of the reason is the upcoming expiry of the November series, because traders tend to square up their expiring month contracts and go for the next month contracts. That results in dual turnover being recorded. Nevertheless, it is also an indicator of increased risk. Now, index options, which are the least volatile counters in the F&O segment, saw lower turnover contribution by 65 basis points, indicated as a green line. In the relatively lower risk options segment, it was the stock options that saw turnover contribution go up by 51 basis points, indicated by a purple line. So overall, I would say risk appetite was higher. Friends, I now come to my own trading strategy for the week ahead. It's not likely to change much. I remain with my time-tested strategy of trading smaller lots. A, because it's the expiry week, and B, volatility has jumped on Friday, so that could lead to whipsaws. So small lots, I would wait for bigger price moves, as I have explained to you in this video. I would also be very wary of keeping naked exposure, which is why I would keep tail risk or Hacienda hedges, which is indicated in this video. And I would focus on PSUs because of the simple reason that MWPL is still concentrated around there. There's a lot of emotional and financial commitment of the average retail guy in these counters. Now, within the PSU space or public sector units, undertakings, I would particularly focus on OMCs, oil marketing companies. Do remember, crude oil has jumped last week. I would also go for energy, power, public sector banks, and logistics companies. I would pay some amount of attention to the metal mining stocks. I'll explain to you why. The metal mining counters will get more volatile due to routine month-end short covering on metals in commodity exchanges, and oil and gas may attempt to rise, but higher levels may encounter resistance on advances. So theta decay still remains a valid strategy on oil and gas. Bullion, I think, is still a very robust long-term buy on dip strategy, and long-term investors who are willing to overlook the short-term volatility of calendar year 2024 and look beyond 2025 also are still to see the best of bullion to come. I have explained to you why bullion is a buy on dips, and I think updated video on my strategy on falling bullion prices is justified, provided I get a lot of feedback from you asking for more videos on bullion from here onwards. Interest rate sensitives, which is banks, NBFCs, companies heavily dependent on EMI based sales, and companies that are up to here in debt. These are also counters that I would watch out for and play for theta decay on these counters. Friends, the coming week is an expiry one, so I would basically walk on eggshells, play a very careful hand. Now, friends, for my view on whether the rally that you saw on Friday was short covering or was it fresh buying, and will it last? Take a look at the ticket size per trade chart of the overall market. This is the average ticket size per trade market wide. The price chart is of the Nifty prompt month or the first month futures, and the ticket size per trade tells you that on Friday, this TST, which is the number of lots traded in every transaction, was the highest after 1st of November 2024. Very clearly, traders were taking bigger bites of number of lots per transaction. Now, who can do that? A small guy, even if he wants to, cannot write out bigger checks due to financial constraints. So when ticket size per trade goes up, it's a very clear indicator that smart money is in the market. So yes, smart money did buy. Now, whether was it short covering or was it fresh buying? It was more of short covering because MWPL actually contracted on Friday. All right. So if at all it is fresh buying by institutional and HNI hands, your ticket size per trade should go up, your MWPL should go up, your traded turnover should also go up. So statistical weight of evidence does not support that it was aggressive fresh buying. Can things change in the week ahead? Yes, they can. As a matter of fact, the ticket size per trade as a metric is something I have updated and added an additional row in the daily post-market summation that I put up on all my social media accounts. So Monday onwards, you will be getting TSTs updated along with all the other metrics on my social media accounts. Friends, before I wind up this video, request to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what you think about my work and how it makes you improve your trading performance. Also, please share my videos with smart traders like yourselves and help me reach out to a wider audience. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.